The price target of 150,000 is actually based on work from our head of digital strategy, Farrell, and he's looking at a combination of his essentially what looks like a stock to flow model and a essential, like basically a price to book model. You know, what is Bitcoin cost to produce, and what is that break even, and what multiple should you assign to that? And he triangulates to 150,000 roughly by the end of the year. And I think that's pretty achievable. I mean, it really principally only happens if the S&P actually can rally into the end of the year, and that's our base case.
Tom Lee begins by addressing the complexities of Bitcoin's price movements in the short term. He acknowledges that numerous factors beyond fundamentals, such as geopolitical events or market sentiment, can influence Bitcoin's price. For instance, recent events like the issues surrounding Mt. Gox and economic developments in Germany have created short-term headwinds for Bitcoin. These factors, while impactful in the immediate term, do not alter Lee's long-term bullish outlook on Bitcoin. He emphasizes that despite these temporary disruptions, the fundamentals of Bitcoin remain strong, and the digital asset's future is bright. One of the key points Tom Lee discusses is the price target for Bitcoin, which his team at Fundstrat has set at $150,000. This target is not pulled from thin air, but is based on rigorous analysis conducted by Farrell, the head of digital strategy at Fundstrat. Farrell's approach combines elements of the stock-to-flow model and a price-to-book model, focusing on the cost of producing Bitcoin and the appropriate multiples that should be applied to it. Lee believes that this target is achievable, especially if the S&P 500 rallies as expected, providing a supportive environment for Bitcoin's growth.
Because in the short term, there's a lot more factors beyond fundamentals that affect a price of anything that trades on a market. And for instance, just recently, everything happening out of Germany and Mt. Gox is creating short-term headwinds and potentially even breaking technical patterns, but it doesn't change where Bitcoin should be 5 years from now. But the price target of 150,000 is actually based on work from our head of digital strategy, Farrell, and he's looking at a combination of his essentially what looks like a stock to flow model and a essential, like basically a price to book model. What is Bitcoin cost to produce, and what is that break even, and what multiple should you assign to that? And he triangulates to 150,000 roughly by the end of the year. And I think that's pretty achievable. I mean, it really principally only happens if the S&P actually can rally into the end of the year, and that's our base case. And, someone's asking, why should they be interested in Bitcoin? So let's say you have some folks listening to this and are maybe curious, but they're not convinced they should own any. I mean, I think that question has already long been settled because, Bitcoin is now essentially a bona fide asset class. I mean, it has the backing of BlackRock, which is the largest asset manager in the world. Larry Fink, even today, was speaking post-earnings about how important Bitcoin is to the future of BlackRock, and it's something that they're encouraging clients to adopt. I think that the mistake someone might make if they're interested in Bitcoin is thinking they have to go 100% of their portfolio into it. They only need to put 2% or 5%. And, if you think about someone sitting on cash, that's like 1 year's worth of interest on their portfolio. They just have to dedicate to crypto. We made that recommendation when we first wrote about Bitcoin, that they should put 1 to 2%. Today, if they didn't rebalance that recommendation, it's 80% of their total portfolio. So it's been a huge winner for our clients, and many have told us it's really changed their lives by making what they saw as a kind of a low risk bet, 2% allocation into crypto. And I think that's how people should look at it today, because Bitcoin isn't peaking. It's not that widely adopted yet. There's still so many skeptics, and there's many financial firms that are restricting their clients from having access to exchange versions of Bitcoin. So the ETF today is not even approved for many firms, and it tells me that there's still a lot of future holders of crypto. And I think the mistake someone could make today thinking Bitcoin's not relevant is the financial system does work really well in the US for wealthy Americans, but even in America, I think that only 45% of Americans actually have a bank account, and another 25% consider prepaid credit cards and debit cards as their primary form of banking. I mean, banking is very expensive in America, and that's for one of the wealthiest nations in the world. Outside the US, crypto is really going to prove to be a much more low-cost banking system for folks, especially if they want to do remittances and move money around the world. I think that maybe as sort of a minimum sort of target for Bitcoin, like, hey, when does Bitcoin have to reevaluate whether it's peaking, is when the value of Bitcoin exceeds the value of above ground gold today. And that's 16 trillion. And the reason I think that's a fair benchmark is that, gold might have some industrial uses and it has jewelry uses, but the principal reason it's got 16 trillion of value is it's viewed as almost a singular hedge against currencies and against calamity. And to me, Bitcoin is far more resilient and useful if we were ever in a circumstance where you actually need to start using gold. I mean, if you try to, carry $1 million worth of gold, you probably need a couple friends to help carry that. You can carry $1 million of Bitcoin on a wallet, or in your mind if you can memorize your address. So to me, I think it's a far more useful hedge against calamity. But on top of that, of course, it has other uses. In fact, over time, it's arguably going to be pretty widely used. Maybe not for direct payments, but as a source of collateral or type of collateral. And so I don't know. So it'll be some multiple of what gold is today, but I would say reaching 16 trillion seems somewhat reasonable.
Lee offers practical advice on how to approach investing in the digital asset. He notes that investors don't need to buy an entire Bitcoin to benefit from its growth. Instead, they can start with small amounts, even purchasing fractional satoshis. The availability of Bitcoin ETF and the ability to easily buy Bitcoin through traditional financial platforms like Schwab have lowered the barrier to entry, making it accessible to a broader audience. Lee emphasizes that Bitcoin's inclusion in portfolios is less about speculation and more about diversification and hedging against inflation.
Pretty eye-opening if someone is skeptical of crypto, and now you see in a presidential campaign, one of the parties supporting Bitcoin and even accepting donations in crypto, and we're not talking a fringe candidate, it's someone who betting markets think has a 65% chance of becoming the next president. I think it's a huge deal, and it makes a lot of sense because Bitcoin is already probably quite widely used by many government agencies anyways. I think that's what people forget, is that they think Bitcoin is only used by like pirates and drug dealers, and that's not the case. I'd say it's probably only 15% of all network activity today. I'm sure you've noticed, and a lot of these listeners have noticed, that there is a generational bias against crypto, that those who are against it tend to be older, and that's because the traditional financial system suits them well, and maybe people know stocks and bonds, and they might know gold, but they don't really know if they care for this digital thing. But what people forget is that the global economy increasingly, the growth in GDP is increasingly native digital. AI is actually proving this. All of the value creation in AI isn't in the physical world, it's in the digital world. And is it an overestimation to say that in the next 10 years, 75% of all incremental GDP is native digital? If it probably is, then do we need arcane definitions like local currencies? And why wouldn't it be a digital-based money is actually the preferred way to actually settle payments? So I would say, to me, it looks like as time passes, this generational objection is going to disappear. If they're skeptical of owning Bitcoin, there's many ways to buy it so easily, and they can change their mind. They can buy an ETF now, and they don't have to hold their private key and worry about securing that and, you know, passphrases. They can just click it on Schwab. I mean, that's the big change this year. And hey, if they have a stop loss of 10%, they can just hold it and sell it if they can't tolerate the volatility. And why does it matter? Well, look, at the end of the day, it's already a new asset class. I mean, there's many asset classes created in the past generation that people forget. Commodities is an asset class that was created through the ETF process. Before that, you actually had to be a direct investor. MLPs and energy is an asset class that was created in this past generation. You couldn't own energy pipelines, et cetera, before unless you were an oilman. Volatility and VIX products and structured products around, you know, the VIX, that all came in this generation. And even owning real estate through bonds and equities. I mean, so to me, if someone doesn't think Bitcoin is a bona fide asset class, they've forgotten many things that are in their portfolios today didn't exist as an asset class one generation ago. I think what the mistake people think is they have to buy a whole Bitcoin and come up with, you know, $63,000. I mean, they can buy a Satoshi every day instead of a latte. And more importantly, you know, if Bitcoin network value plays out and Bitcoin, yeah, let's take Urian's number, but let's say Bitcoin is 1 million. Okay, so it's a 20 times increase from here. Anyone who's long Bitcoin won't care about inflation, you know, and that's the important thing, because it's really just the dollar getting cheaper. It's not, I mean, that's really what they're experiencing. So, you know, I think the mining industry, and, you know, we with the halving, a lot of the smaller miners got into trouble, and hash power is going to be concentrated. That's actually healthy, because the larger scale miners, as you're pointing out, can be quite innovative, you know, and so I think mining is actually incredibly important. I mean, mining is important for Bitcoin. I mean, there is no Bitcoin without mining, and the miners, I'd say it's been trickier as equities, because I'm thinking about them as stocks, because they are essentially beta to Bitcoin. But I'd say over the course of the cycle, they should outperform Bitcoin. But it's, you know, of course, I know it's been tough, because, you know, we have a lot of clients that have been long miners, and, you know, today's been an okay day, but really for this year, it's been very painful for them to own it versus Bitcoin.
Tom Lee also touches on the importance of Bitcoin mining, which he sees as critical to the ecosystem. Despite the challenges faced by miners, particularly during periods of low Bitcoin prices, Lee believes that mining will continue to be a vital component of the Bitcoin network. He sees the consolidation of mining power among larger, more innovative players as a positive development, ensuring the network's security and sustainability. Moreover, Lee suggests that over the course of the market cycle, mining stocks could outperform Bitcoin itself, providing additional opportunities for investors. Please like and subscribe my channel.